If you have a rollover IRA or pre-tax qualified plan assets, and you want to maximize the amount that you pass on to your heirs, children, and/or grandchildren, which outcome would you prefer? The answer may seem obvious to you, but the blue line is what happens when you just do nothing and take RMDs without a tax-smart exit plan. Choose the green line for significant increased family wealth and legacy when you roll over your IRA funds into our proprietary, tax-efficient qualified plan transfer. The problem is that most people think their IRAs are tax-efficient. That was the whole reason they did this in the first place. And they contributed for a long time. Attention! If you've reached a level of financial success and security where you no longer need these pre-tax IRA funds to retire on, you are likely to pay double taxes. First, income taxes when distributed, and second, with estate taxes. Even if you are in a state with no state income tax, the total is almost 65%. As an example, one of our clients' estates was valued at just over $29 million, of which $2 million was held inside an IRA. They said they were never going to use for lifestyle expenses. They mistakenly thought they were just going to pass on their IRA to their kids. But then they realized that they were going to get hit with 37% in federal income tax, plus another 8% in New Jersey state income tax when it was time to take their RMDs. And then, to add insult to injury, these funds were also going to get hit with another 40% in estate tax at their end of life. So at their end of life, their $2 million in IRA funds were going to be subject to 45% in income taxes, taking the net value down to only $1.1 million, plus another 40% in estate taxes will be due on that value, which means their kids were only going to end up with $660,000 of their $2 million IRA. Think about that for a second. Their $2 million IRA was only going to be worth 33% of its value when their kids inherit it, because 67% of it was going to be confiscated in the form of taxes. By using our proprietary qualified plan transfer, they could roll over that $2 million into the IRS-approved proprietary qualified plan transfer, and that $2 million could be used to buy a $10 million survivorship life insurance policy, utilizing pre-tax dollars and money which ordinarily would be paid to taxes. In year 5, your wealth transfer trust would then buy the policy out of the pension plan using an irrevocable life insurance trust. The proprietary qualified plan transfer at that point may be fully funded, or you may have the option to make additional annual investments/premiums may be made to substantially increase your legacy. So at their end of life, your heirs would receive $10.3 million income and estate tax-free. To give you an idea of how this compares to leaving the money inside the IRA after the double taxation, here's what it looks like. With a $2 million starting IRA value, growing tax-deferred at 7%. At age 90, the IRA would have a gross value of $7.2 million, but after the 45% in income taxes, the net value would only be $3.9 million. But that's not it. There would still be 40% in estate taxes due, which means that after 20 years, the kids would only get $2.3 million. After 20 years of tax-deferred growth, earning 7% every year with no down years. Here's what it looks like over 30 years until the wife turns age 100. Again, the green line is the IRA's net after-tax value that we just looked at, and the blue line is the proprietary qualified plan transfer. Again, which one would you rather have? The green line or the blue line? There are no reasons for anyone to pay more taxes than they have to. So if you want more certainty in maximizing tax efficiency and predictable wealth for your heirs for generations, please contact us today for a no-obligation proprietary tax-efficient plan for you and your heirs. You will be glad that you did. A Roth conversion will not work better and is often subject to double taxation. Call or email us today.